Good afternoon. My name is Dave Giulio. I'm the director of the Center for Civic Engagement here at Oakland University. Welcome to office hours. Just a bit of background. We've been doing these virtually for the past couple of years with the intention of highlighting some faculty experts here at Oakland University on some topics that are timely and topical. And we've got another one of those for you today. Obviously, we're back to trying to do it in person. We've had a few, we're starting a little late today because we've had a few technical difficulties, as you can imagine with the, well, everybody's used to those by now. But as I said, with office hours, it's our intention at the Center for Civic Engagement to make Oakland University known as a convener of conversations about issues of public importance. And boy, we have a good one for you today on the topic of the economy. So we're going to start, as if you're back for office hours, you know this is an informal conversation with some faculty colleagues of mine. If you're new to office hours, it's an informal conversation with some faculty members. And they're really fun, informative, and as I said, timely and topical. We are delighted to be back in the Oakland Center to be able to do these in person. We hope to continue to grow this effort and see the OC again packed, although it's pretty packed right now during GrizFest here. Thanks to those that are joining online via Zoom. Thanks to Chris Reed and his team in the Oakland Center. Thanks to Xander, Ryan, and the rest of the folks here for the tech help. I am delighted to be joined by two of our esteemed professors of economics from the School of Business Administration. Man Jin is here with me on the couch here in the Oakland Center. We've got a nice fire behind us. And Professor Ron Tracy is online. Hi, Ron, how are you? Ron, did we lose you? All right, hi, Mon, how are you?
Good. Thank you, Dave. Thank you for inviting me. This is my first time joining the office hour, and so
well, we hope to have you back.
I'm unmuted now.
There's Ron. Can you hear us, Ron?
Yeah, I can. I'm unmuted now.
Oh, perfect. All right, so let's jump right into this. The economy is an issue that everyone seems to have been talking about for a long time. And I think that that's driven by at least a couple of things that are affecting people in their daily life, right? And so let's start at sort of the top level of this, inflation, yeah. Right? Can you both tell us why, and we'll start with Mon. You know, why have we seen inflation expand so much in the last year and a half? Why is inflation so high these days?
Yeah, there are multiple reasons behind the story of inflation. In the beginning of the pandemic, to stimulate the economy due to lockdown and all the related health issues, Federal Reserve, the central bank of the United States, have to increase money supply so that we give people extra credit, extra money, they will increase their spending so that we can avoid a slowdown or recession in this kind of extreme circumstances. But with that, the consequence is there are too many money supply circulating in the economy. Then people buy without demand for goods and services being so high, it drives up the price, goes to such a high level. We're seeing historical high inflation right now. It goes down a little bit from the previous statistic. It was 9.1 in June, and in July it goes down to 8.5. So that's due to the Fed's aggressive tightening monetary policy. But address to your question, that Fed's policy is one reason response to the high inflation.
So and before we bring Ron in here, just a quick follow up on that. Yeah. So one of the things that I've been reading over the last many months is that part of the reason for the increased inflation and also right, that I think it's important to put it in proper perspective for folks, right? That 9.1% that it was last month or 2 months ago, and the 8.5 that it was last month.
Yeah.
What does that mean? And also some of the things I've read is that the COVID policies that were implemented with pushing money into the economy when things were shut down had a pretty large impact on that as well. Is that accurate in your mind?
In my mind, that's accurate. So first of all, what is 9.1? What is 8.5 that we're reading? So this is annual increase in the overall price level according to CPI. CPI is just one measure of
And that's the
inflation.
consumer price index,
That's the
correct?
consumer price index. That's the most popular one. And according to that, the overall price level, including like everything we consumed as a typical consumer, food, transportation, housing, education, healthcare, overall it goes up by 9.1% from previous year as of June 2022. So that means we're paying more, right? Not 9.1% more compared with previous year. And if there is no wage increase, there is no investment, satisfactory investment from your return, then we are losing money by just holding cash. So that's why that's a big impact for our life as a typical consumer. And according to your response to your second question, the initial policy from the Department of Treasury, from the government, yes, it's also responsible to the high inflation because we have stimulus check. We have all this kind of COVID relief program that give small business credit. And those money jump into the market in a large volume, also responsible to the high inflation that we're having. In addition to that, energy price is also one reason that oil price goes so high. So that's.
Ron, you want to jump in there?
Yeah. First of all, it's important to remember that inflation is a monetary phenomenon. So has COVID had an impact? Yes. When the federal government increased COVID spending, if the Federal Reserve had not been increasing the money supply, it would have raised prices, but it wouldn't have been inflationary. Remember, inflation is a monetary phenomenon. The Fed's increasing of the monetary of the money supply due to COVID always has a delayed effect, and we are seeing that effect now. Certainly the COVID expenditures, because of this increase in the money supply, has added to inflation. I think more important than the total CPI, which is 8.5%, is the core CPI, and that is at 5.9%. And to me, that is much more relevant and concerning than the overall, which includes food and energy at the same time. And if that doesn't start coming down, it's going to be very hard for the Fed to.
So let's start with the Federal Reserve, right? What does the Fed do?
Federal Reserve is the Central Bank of the United States. It has the Board of Governors, which is like the headquarters. And there is also a FOMC, the Federal Open Market Committee, which is the committee that defines the monetary policy, whether to increase money supply or decrease money
And what is the money supply? What is that?
Money supply is the total amount of money, cash, the credit circulating inside of the economy. So Fed can print money and then inject into the economy through open market operation. It's not like just spreading money from a helicopter, right? It's not that. So
That would be nice, wouldn't it, if they just drop money on us?
yeah, that would be nice. The actual action that you're doing is through treasury bond, purchase or sell treasury bond, so that they can increase and decrease money supply.
And it's important to remember that it is not just currency, it is also checking accounts and savings accounts that's considered money, because you can go to the store and you can go and draw from your debit account and everything else. And that adds to the money supply.
Yeah.
So let's switch gears just a little bit and talk about another element of what the Fed does, right? Interest rates.
Yes.
How does the Fed set interest rates? And if there's some small group, relatively small group of people in Washington, D.C. that are meeting at the Federal Reserve,
Yeah.
that are setting interest rates, either raising them or lowering them. I read the other day yesterday that the Fed chairman, Mr. Powell, seems to be signaling another rate increase of 3/4 of a point. What is that going to mean for the economy? What is that going to mean for inflation? How does that impact folks on a personal level?
Can I start this answer?
Absolutely.
First of all, the Federal Reserve does not change interest rates as you and I know them. The Federal Reserve deals with what's called the Fed funds rate. How they go, and that's what they're going to be raising by 0.75% is their target and say, this is what we want banks to do. Banks can ignore it, but the way they make it happen then is through changes in the money supply that we have been talking about. So if they want to raise interest rates, they slow the growth of the money supply. That causes interest rates to rise. The Fed does not set normal interest rates. They are market determined.
But we do see interest rates rise and fall with Fed activity, correct?
Because of the changes in the money supply.
And those market forces. So it does sort of flow down to the consumer through other interest rates.
Yeah, it's just like a regular demand and supply momentum, right? If you increase the demand, price will go down. So interest rate can consider as the price of money. It's the opportunity cost of holding money. It's just the price of money. So if Fed increase money supply, and then it will decrease the interest rate and reduce money supply or reduce the growth of money supply, it will increase interest rate. So when interest rate goes up, that will impact not just consumer but also business. For consumer, see right now interest rate is good. Using Series I bond as an example, that's kind of the Department of Treasury issued inflation-based bond. The current interest rate is 9.62. So that's pretty satisfactory considering the current stock market is so volatile. So as a typical consumer, I have additional cash. I would put my money into some kind of investment like a fund instead of buy refrigerator, buy new iPhone. Right? So when we have higher interest rate, people save and spend less. That will cool the economy down. Vice versa, when the interest rate is low, people, saving doesn't help me a lot, right? So I will increase my spending by especially durables like iPhone, laptop, so that our economy will be stimulated with lower interest rate.
And that extends to larger purchases too, like homes and cars, correct?
Exactly. It works the same way as business investment. Interest rate is low, then the borrowing cost is low. I will borrow more, I will invest, I will hire more people. Interest rate is high, my borrowing cost to invest is high. So I will do the opposite, reduce employment, reduce investment.
And David, those goods you mentioned of cars and homes are durable goods. And those are the first goods that people avoid buying if they think a recession is coming. And we have seen some decreases in that over the last couple of months, indicating that consumers are concerned about a possible recession.
And I'm glad you brought up the R word, Ron. But that's, we see that with the housing market, right? Where fewer people are purchasing homes, I imagine in large part because interest rates have gone up for mortgages, correct? And people just don't want to pay that much for to purchase a home, right?
Yeah, housing market is having a difficult time right now. We have the largest 6 months decline in home sale. And the number is like a 20% less than what we have a year ago. Interest rate that Fed is trying to target. Some data show that right now 30-year fixed mortgage interest rate is as high as 5.5%, which is 2% higher than a couple of months ago. Right? So that's additional cost for home buyers. And then housing, the entire real estate is cooling down. That's also some signals that people are worried about the uncertainty of the future and worried about the recession.
So, and I would be remiss if I didn't remind our attendees online and those of you that are here. If you'd like to ask a question yourself, we can take them from the audience. If you're online, please feel free to put them in the chat. Ryan, I will get to you momentarily. I do want to talk about the R word, recession. And, you know, as a political scientist, the economy and politics are linked quite strongly. And I think we saw that in the last month or so, when the last round of GDP numbers came out, which showed 2 consecutive quarters of negative economic growth. Some folks started to scream, "Oh my gosh, we're in a recession. What are we going to do? We're in a recession. Oh my gosh." And then others, chiefly the Biden administration and the White House, said, "Oh, no, we're not in a recession." So my question to both of you is, are we in a recession or not?
Ron, do you want to take that one?
Sure. The problem with the 2 consecutive quarters of declining real GDP is that it overpredicts possible recessions. Therefore, we don't use that solely. Have we ever had a recession that didn't occur? No, it's true. But just because it happens doesn't mean it's going to have a recession. There are other things we have to look at. And that is why there's we may be in one now, but it may be a little later. I honestly, this is my opinion, believe we'll be in one by the end of the year. Others think it's going to take longer than that. But I think we're headed to one, because only way we can really dampen inflationary expectations is through a recession. How deep is the question?
Man, you have anything to add to that?
Yeah, I agree with Ron. In my point of view, we are not in a recession yet. So the data shows that, yes, last quarter, the decline in real GDP, the real term, get rid of the inflation impact, is negative 1.9, and last quarter is 0.9%. So that's the textbook definition for a recession. But I think the definition is a little bit outdated.
Oh, yes.
Yeah, according to NBER, the National Bureau of Economic Research, a group of elite economists, they have a new definition of recession, which is economy has significant drop down over the few months. There's no specific like a deadline, specific numbers, specific duration.
So, okay, so that's really interesting. So let me ask you this: what are the other indicators that would go into the NBER's analysis or analysis of whether or not we're in recession? Because for as long as I've paid attention, right? I mean, and this is the political angle.
Yeah.
Is two quarters of negative growth. Yeah. Is the bang on definition of a recession. So what else goes into it these days?
So one is GDP. The other is called gross domestic income. It's more like the income side, not the spending side. So the gross domestic income actually get a positive 1.8% increase in the first quarter. So NBER is taking the average of GDP and gross domestic income. And one is positive 1.8, the other is negative 1.6. Sorry, correct my previous data. So the average of them is still showing a positive growth. So according to the measures that the NBER, the group of elite economists analysis, is we are in a technical recession. That's what Pat mentioned as well. So it's the textbook defined. But if we look at our labor market, there is no sign of higher unemployment rate like we said previously.
Yeah, Ron, do you have anything to add?
Yeah, I would just say that we also are looking at change in inventories and consumer confidence. There's about 5 things that the NBER is looking at, and it makes it a lot harder for them to make a decision if you're in a recession than it used to be. So it sometimes takes them 9 or 10, 12 months after a recession starts before they finally say, yeah, we now know we were in a recession a year ago.
So the takeaway for me then is that this is a much more complex and really subtle distinction
yeah.
than maybe some would have us believe. And although you know, from a political standpoint, it's interesting to watch the White House try to make that case.
Yeah.
When for years and years, it's been those 2 quarters, and they try to come in and say, well, wait a minute, there's the NBER, and they're going to decide in December if we're in a recession now, and it's this complex answer to a simple question,
Exactly.
which makes it difficult for the politicians and elected officials.
And the Democrats obviously do not want a recession going into the election, and the Republicans want one badly, so they win. So both sort of have their own way of spinning everything.
I appreciate Ron's candor and frankness on that. Yes, that is the long and short of it. Ryan, what's your question? And I'll just repeat it for the online folks. Prioritize.
Because we were talking about the housing market.
Okay.
Values are higher. How is that? Recession.
All right, the question is about housing market, high values, low values in different areas, and how's that related to recession?
Well, how is it related to like the
Inflation.
Yeah, thank you for the good question, Ryan. We do see like almost all the big 4 regions in the United States, month over month, year over year decline in the house sale, big decline. But at the same time, the median housing price actually goes up by about 10%. I would say that that's just keep up with the level of inflation. Right? Everything becomes more expensive, and housing is one of them. Well, with inflation, housing price show that, but also the housing market is response to the higher interest rate that we mentioned previously, and also about the uncertainty of the future. Because everybody is talking about recession, that home buyers will be extremely careful. That's a big investment. So the slowdown of the housing market is also reflect our expectation about the future.
Ron, anything to add?
Yeah, new housing construction has been a real problem since COVID started, and because of supply chain problems. And so as a result, what we are mainly seeing are used housing. We are not seeing a lot of new housing, and it's understandable why. Builders don't want to build speculative homes because of what's happening right now. Prices are not stable. So there's a lot of uncertainty right now. And so housing right now is very volatile.
Let's switch gears a bit and talk about an issue that impacts all of us, especially our students here at Oakland University, because many of them commute to campus. It's the gas prices. Let's start very simply. Why are gas prices so high?
There are multiple reasons for that. The one explanation is we all know that the Russian-Ukraine war that make gas supply limited. Right? So again, the basic supply and demand analysis, like supply goes down and then the price goes up. That's one explanation. The other explanation is with our ability to, United States is the net exporter of gas. So we have enough gas. It is after the pandemic, a lot of plants are shutting down. It takes a while for them to reestablish the original level of production. So it takes a while for the oil company to catch up with the current demand. So that's also one explanation of a high gas price. Ron?
Yeah, certainly when we quit driving at the beginning of the COVID, it meant that there was not need for gasoline. And as man said, they shut down refineries. Getting those refineries back up is a much slower process than shutting them down. And so that is certainly why it went way up, and it has been coming down. There's still a lot of volatility and uncertainty in that market, but we have certainly seen a drop from a high of about in Michigan here, about 550 down to, I think I've seen recently about 360, something like that. So it's coming down. It'll continue to come down, but there is uncertainty in it. And as we're driving more right now, means it's slower to come down because they are still getting up all of these refineries.
And before I get to an online audience question on this from John, gas prices seem pretty volatile at times, where you drive by a gas station one day and the price is X, and you drive by the next day and it's X plus 30 cents or X minus 30 cents. Why do they fluctuate so quickly?
So our demand, well, before the pandemic was relatively stable. But in the end of the pandemic, there is some revenge consumption that people go out to travel. People go out to have vacation, that our demand goes up. So the gas price is first of all, because of the mechanism that is pricing, so it's quite volatile day by day. It's driven by the demand and driven by the supply. So my short answer to your question is it's a very dynamic momentum. It changes day by day due to our consumption side, due to our supply side.
Yeah, I agree completely. The supply side is volatile and the demand side is. So right now, there is a lot of volatility in gas prices. There's also volatility in produce prices and food prices right now for somewhat the same reason.
And that gets to John's question online, which is, don't high gas and oil prices increase costs for everything else? And why? If so, why?
They do because of transportation costs, but that is a small portion of the cost of a good. So does it impact it? Absolutely it does. But that is only a small portion of the cost of a good.
For manufacturer, for example, they use gas as one of their material to produce. So when the gas price goes up, their input price goes up. So they have to charge more to balance to break up.
And I'm going to throw an at you that pops to mind as a follow-up. One of the things that I'm hearing you both say is that everything comes back to supply and demand.
Yeah.
As a very basic component of economics, right? That's just the long and the short of it, supply and demand, right? So one of the things we heard when gas prices were really starting to ramp up, when they really became noticeable, is that the federal government was going to release some oil from the Strategic Petroleum Reserve, and I think it was 1 million barrels a day, right? And if this is outside of your expertise, just tell me, but it just pops to my mind, right? What impact does that kind of injection of supply have on prices? Any idea?
What was happening when they did that, and they're still doing it, it's still going on, is they had the real decline in supply, and yet there was now some demand for it, and that caused prices to rise. So they immediately started putting this 1 million barrels a day out there, and that started the beginning of reduced prices. So it has definitely had an impact by taking the supply and shifting it, we would say, to the right, thereby causing the prices to decline. But we still, as I recall, they are continuing that almost until the end of the year. That's my recollection.
Okay. Any other audience questions, either here in the Oakland Center or online? Oh,
That's from John.
Oh, John also wants to know about the large legislative package that just went through the federal government, where we've got the House and Senate passed bills and the president just signed. I forget the fancy acronym that they have for it, but it's being billed as an anti-inflationary act. It's the big climate and healthcare bill. And John wants to know if we're actually going to see a reduction in inflation because of that legislation.
I would say no, not really. It is impacting some sectors, of the economy, but I think that name was given for political reasons more than anything else. So there could be some modest thing, but it is not going to have a major decrease in inflation. What do you
Shocking.
think, man?
I agree with you. I think, well, we should primarily rely on Fed's policy to inflation down. So while there's one part of the act that is about the chip, like to help the semiconductor industry, so that we can solve the chip shortage. And my takeaway from that is that if the chip shortage is solved or relieved in some way or another, we might have more cars available, car price will go down. But that's just one portion of the CPI, one portion.
So that I'm glad you brought that up because I think I forgot about that for months, right? That we see all these cars just sitting in lots, right, waiting for chips to be imported, and that has obviously caused prices of automobiles to rise. Is that still happening? Are we still seeing a really tight supply of automobiles?
Yes, exactly. So Federal Reserve just released their beige book a couple of days earlier this week. So from all the 12 regional districts of Federal Reserve, they do see that, especially in the Detroit area, we do see that all the industry is not doing well. And the chip shortage is still there. And we are waiting for cars, waiting for chips.
So you said too that if the chip shortage is relieved, we should see prices go down.
We should at first probably the price will be stable as long as there is some kind of balance, or like there is enough of some level of kind of supply. We should see the price goes down. Yeah, because yeah.
No, you could finish, man. I'm sorry.
Yeah, so because we're talking about price goes down, so it's one equilibrium to another equilibrium. It won't just like a complete overnight. It take a while.
So and that's something we heard when inflation was really at top of mind, and maybe at its peak levels, right? We kept hearing companies say we're increasing prices because of inflation. We're increasing prices because of supply chain issues, whatever reason was given. And I guess this is a two-part question. One, do we really see prices go down after an era of inflation where people may get used to paying more for certain things, or can to keep prices high?
I think part of this is that when prices go up for inputs and then they slow growth, those higher prices are still there. Therefore, firms are going to be charging the higher price. So, for example, with the auto companies, the MSRP we're all familiar with, when they start, will they be reducing that as their input prices go down? Very slowly. Where we'll see it is that dealers will be starting to let cars go at less than MSRP, and that will then put pressure on the auto companies to reduce MSRP. They are very, very slow at reducing prices, much faster at raising prices.
So that's really interesting. So what about in a time where we have because if MSRP is going, let's just keep the auto example going, right? If MSRPs are going down, but interest rates are going up, is that not a wash?
Yeah, that's a good question. So in my point of view, higher interest rate is a bad signal, right, for people to finance or lease. But there could be some promotion from the financial sector, financial industry, to give you like some bonus to compensate the loss of higher interest rates.
Ron?
Yeah, it's, I don't really have anything to add with what Man just said, because she's absolutely right.
So, and this leads to another question from our online audience. Kevin from Cincinnati wants to know, how does the Fed decide to discontinue adjusting rates?
When they start seeing inflation drop.
Yeah.
Right now, it's that core inflation, not including energy and food. The core inflation, if they start seeing that drop, they will start slowing the change in the money supply and therefore affecting interest rates. But they really have to break those expectations. If you ask people right now what they think inflation is, most people would probably, it's my hunch, say 6%, 5%. If they think that, that's hard to change. It is really hard to change. The only way we know to change it is a recession, unfortunately.
So the Fed's target inflation rate is 2%. They still insist on the 2% inflation rate. So to answer the question a different way, I think the Fed will stop the aggressive tightening monetary policy when they reach the target, which is 2%.
So is that it? So, and that's because no inflation is also bad, right? Because that signals other things, correct?
Signal recession, signal very bad demand.
So Ron said that we'll only see this stop in tightening of money supply and then increasing interest rates when we go into recession. So is it inevitable, even though if the group that is looking beyond the 2 quarters of negative growth, if they're looking beyond just that, are they going to make us go into recession before we stop? Is that your contention, Ron?
Yes, that is probably my contention. The only way we could have avoided this is if the Fed had started acting a year earlier so that the things didn't get so out of control. Now that we have a core inflation of 6%, I don't see any way of bringing that back down, even if it's to 4% or 3%, without at least a modest recession. Do I want a deep recession? No. How deep it is going to be a function of what the Fed has to do. I am hoping for a very mild recession, but only time will tell.
Questions from the audience?
Yeah, so by a lot of metrics, things are still positive, so that's why there's kind of hesitancy to declare a recession. I was wondering if you could provide some color regarding how the Fed's activity affects the corporate bond market. Being that the Fed is near zero interest rate for some time now, we've had record issuance of corporate bonds. So if the Fed's increasing their rates, presumably the corporate bond rates would have to go up, therefore the prices have to go down. Is that kind of what's causing the negative sentiment forecasting for future recession? And does it potentially put us at risk for another liquidity crisis?
So the question is basically above my head, and it's about corporate bond rates. So I will just let Nan answer that one, and Ron jump in if he wants.
Yeah, so as investor, we're doing trade-off, right? Or we can do a package, but you have to allocate your asset between risk-free investment or risky investment. Corporate bond is risky investment, depending on what kind of corporate bond you're investing. Risk-free, such as putting your money into a bank, saving, or Series I bond, like treasury bond. So as the Fed increase interest rate, then we see a lot of risk-free interest rate have been goes up, and then with this kind of uncertainty and our expectation of future, we see a lot of investors are switching to risk-free investment. So that will lower the demand for risky, like corporate bond stock, and that explains that why the stock market is doing bad recently. We see like a 9% decline in the stock index over the last 6 months.
Ron, anything on corporate bonds?
Yeah, I would add that one of the reasons the stock market is so volatile is with interest rates rising, bonds, corporate bonds, or even government bonds become a lot more desirable than stocks. And that has taken money out of the stock market and put it into the bond market for an increase in demand, which increases the price of the bonds, which means the interest rate has fallen, which is what it is, but it's still quite high compared to how it used to be.
I'm glad you mentioned the stock market, because I want to ask about that and bring it back to the Fed too, right? Because it's and I also, because I think there's certainly a political angle to this. And for instance, right, well, I'll come back to that. But every time we see the chairman of the Federal Reserve make a statement about maybe forecasting or foreshadowing Fed policy, the market reacts, right? So just the other day, he sort of signaled this 0.75% increase,
Yeah.
and the market tanked, right? It
Yeah.
went down 1,000 points or something like that.
Yeah.
Why is that? Why does that happen?
One explanation, just as I iterated previously, so stock market are risky investment, right? People will switch from risky to risk. So when Fed release kind of statement that it will increase interest rate, make a government bond, make a corporate bond more attractive, so people will give up, that reduce the demand of stock to lower the price. Another reason is the higher interest rate is also indication of less investment in the future, less consumption in the future, or probably a recession in the future. So stock, of course, is very sensitive to the future of the economy, and they react aggressively in this way about their forecast of future.
But it's all speculation. and the stock market is very much run by speculation. So as a good measure of what's going to be happening in the economy, it's only mediocre at best because it has so many other things impacting it. One of the things that we have is with all the 403Bs and 401Ks and IRAs, they got to put the money someplace. And so it goes into stock market, bond market, or someplace, but it's got to go someplace.
So Ron, you used the word speculation. Is it fair to say that perception is a real factor in how the economy is judged by regular folks, right? You're talking about, or maybe Dan was talking about the inflation rate and what people think it is, right? So how big of a factor is just simple Americans, everyday Americans' perception of what the economy is on how it is going to perform?
It's huge because consumer confidence is directly related to that. And most recessions are caused by consumer confidence dropping and individuals becoming cautious, reducing durable good consumption, and then starting to reduce other consumption. And so it is huge. And that is why the Fed, with its saying it's going to raise interest rates another 0.75, people say, oh my God, we are going to go into a recession. And they're concerned. And again, we don't know if it's a modest recession, a mild recession. Most of the audience is not old enough to remember the '82 recession, which was really deep.
Man, anything to add?
Yeah, so I use a different term, but similarly, I use expectation. So that's really common in our daily life, that our expectation will impact price. For example, in the beginning of the Russian-Ukraine war, that we are expecting the gas supply will be limited and gas price will go down. So people wait like hours or half an hour in front of Costco gas station. So this kind of expectation of future will increase our demand or decrease our demand today and change our price and the related goods.
We've got 10 or 15 minutes left before we wrap things up. If you are online via Zoom, feel free to put your question in the Q&A. Ryan, one more? Oh, and then we'll go to Don.
It's about like minimum wage. And I know it's like a lot.
So how does increasing the minimum wage,
Yeah.
maybe to $15 an hour, California just decided that the state government will be able to set wages for fast food workers, right? What kind of impact might that have on inflation?
Well, I would say not much. First of all, the people are living on minimum wage is 2 to 4% of total population. So not a big group. We are paid, most of us experience like higher wage than the minimum wage. I have some recent data so that currently our salary for non-farm US worker is $36. So that's way above the minimum wage, especially the federal level minimum wage. So the policy for me is more like politically related. It doesn't have a huge impact on our daily life because we are way above the minimum wage.
Interesting.
I would add that.
Sorry, go ahead.
I would add that it's regional. Urban areas right now, what they're paying as a minimum is generally greater than $15 an hour in urban areas. So most urban areas in this economy are not going to be impacted unless we go into a recession. Then that'll start having an impact. And some of those people may lose their job because of if we raise it to $15 an hour. It's also in rural areas, the $15 an hour is going to be viewed a lot differently because they have their low wage earners are earning less than 15 and therefore they may not employ as many. But most of our working population is in urban areas. So as a result, I agree with man, the overall impact is probably pretty small.
Don, faculty colleague from the Department of History, Mr. Don. Professor Don Matthews.
When the Treasury Department issues bonds to cover federal deficit spending, does that have any effect, direct or indirect, on the money supply, or is that entirely in the hands of the Fed?
So the question is about Treasury bonds and being used to cover
And their effect on the money supply?
to cover our deficit,
Yes.
and what effect, if any, does that have on the money supply?
You want to start?
Sure. The most Treasury bond T-bills are owned by the Federal Reserve. So when the government wants to go and issue new T-bills, they are going with the Federal Reserve to deal with how that is going to happen. They just don't dump them out there. That's not how it's done. So as a result, it is certainly part of the thing that is going on. But the Fed absorbs a lot of those as the federal government is trying to cover its deficit. And remember, though, inflation is a monetary phenomena. So as a result, if they actually are increasing the money supply, and that would be if they are buying these T-bills, it is going to go and cause inflation. And that's why they are trying to just hold them themselves right now. And it adds complexity, but it's nothing that the Fed can't handle.
And anything? Okay. In the last few minutes here, let's swing it back to something that Ron said before, and that's the politics of all this, right? We're clearly a runaway train toward election day with less than 9 weeks to go before we have elections for U.S. House, U.S. Senate, and certainly here in Michigan, governor, et cetera, et cetera. What can the government do about the economy? And let's separate that from the Federal Reserve, right? They are a separate entity. They have no, they're not connected to the White House. They're an independent government agency, right? But what can what, if anything, can the government do? Because let's go back to the expectations game, right? Many Americans expect the president to usher in good economic times, and he often pays the price for bad economic times, right? Usually, you can, as the economy goes down, so does the president's approval rate. As the economy goes up, so does the president's approval rate, right? My contention is that the president gets far too much credit for a good economy and far too much blame for a bad economy. Is that a fair statement? And two, what can if there's not much that the president can do, and you know, we think that the last thing that the Congress did is that's called the Anti-Inflation Act or whatever, Inflation Reduction Act, isn't going to do it. What can the government do, if anything?
So I completely agree with your first statement. You said there is a business cycle. The economy just fluctuating naturally, going up and down, up and down. So you do well, not probably because of your policy, it's just because the economy is on the way to a good outcome. So I would just suggest something maybe a little bit less under the spotlight, which is climate change. Recently, especially this summer, we have experienced different weather all over the world. So there is an economic cost of climate change. We are all paying the price, right? People in California are paying much higher electricity use because of the hot weather. So under my expectation of future, that the economic cost of climate change will become higher and higher. And there is nothing as an individual we can do. We cannot do too much to have a big proposal to save the environment, to do the environmental protection. That must be something led by the government to do something like about the climate change.
Ron?
I would add that, first of all, if we start going into recession, something called the built-in stabilizers take effect immediately. What happens is tax rates, because of people being unemployed, start nationally going down. And because of unemployment insurance, they are starting to get some government improvements, subsidies. If the recession becomes very bad, the federal government may do some kind of discretionary fiscal policy, but that is going to be way down the road compared to the upcoming election. Between now and the election, the federal government has minimal impact of what it's going to do, because the built-in stabilizers have to wait until we start seeing unemployment going up before we start seeing these things. And unemployment lags the economy, always does.
So as we have our last couple minutes here, I would just ask Nan and Ron to tell our audience what should they be keeping an eye on in the next, well, for me, it's as a political scientist again, right? It's until election day, right? So that's one marker, right? What should people be keeping an eye on before election day as it's related to the economy? And then how about until the end of the year, right? In terms of the general health of the economy here in Michigan or in the U.S. generally. We'll start with Nan.
So based on our conversation today, next week we will have the new data about last month's CPI index. So in addition to CPI index, also there is an index called PCE, personal expenditure consumption. That's actually a better measure for our overall price level in the point of view of Fed. Fed prefer PCE more than CPI, but CPI is more popular, so Fed is CPI. So that data can also show us how good the currently monetary policy is working. We can also wait till the later of September. That's the next Fed's committee meeting. Will know that whether 75 basis point is the policy or not. And we can see that how the stock market and the other markets react to the Fed's next round.
Ron?
I would add that we should probably also be looking at real GDP growth. Third quarter ends in the end of September and will be coming out probably fairly early or mid-October. It'll be before the election, and to see if that is negative again, which would certainly suggest the chances of a recession have increased substantially. And you can also look to see if unemployment rate is slowly starting to increase. We saw an increase just recently, but as I said, it lags the economy by a good 6 months. So I would say to pay attention to inflation, like Mann said, and what's going to be happening with real GDP growth.
Terrific. Thank you both for being part of office hours. Of course, we'll have to do it again. Thanks to the audience for being here, both in person, which is just terrific. It's great again to be back in the Oakland Center for these kinds of things. Thanks to the audience online. Join us again in about a month. We'll be back in October 6th, same time, same place, same bat channel for the next office hours on sustainability and climate.
Thank you, guys.
Thanks, everybody. Have a great afternoon.
Good day.
Thank you.